Good morning and welcome back to Almus Market Mornings. The war in Iran has extended to its fourth week with no signs of de-escalation. Threats are being exchanged by both sides, keeping everyone nervous, and generally there is a prevailing gloomy sentiment. And fairly so, countries are somewhat in crisis mode trying to secure their supply of oil and gas despite these higher prices to avoid creating a humanitarian crisis. Markets have reflected this gloom with asset prices taking a severe beating, and so has precious metals. Last week, gold lost about 10.5%, while silver was down almost 16%. We saw sharp selling even in bonds, keeping yields elevated. Good morning, JK. What kind of moves are we expecting this week? I mean, it's almost impossible to predict nowadays, but what does your wisdom say?
Good morning, Swaraj. Generally, you can say that the bearish moves in almost all the asset markets are set to continue because the war has already taken you know, almost everyone and into economy with a heavy toll. The worst part is there is not even a hint of countries involved in the war getting into any sort of de-escalation talks. Yeah, even if one of the three countries directly involved in the war makes a mention of an end to the war, the next hour we have an attack by another and set up for a round of retaliation by others too. So the world seems to be resigned now to seeing the war continue much longer, and efforts are more directed towards, you know, planning for more dire outcome. The humanitarian impact, which you mentioned, is very important because yesterday we had, two important statements. U.S. Initially said they are giving a deadline of 48 hours to Iran for uh, destroying their power generation plants if they did not open the Hormuz Strait. And in retaliation, Iran said if they are attacked, they are going to destroy all the infrastructure of the US in the Gulf region, including the desalination plant. You can imagine the kind of chaos that this will create. So I think this is ongoing and it is not likely to, there is no hint that this is going to end very soon. The only positive thing that we can say is now the rest of the world is united in opposing the war and firmly denied any support. More appreciably, the neighboring Gulf countries have observed extreme restraint despite being undeservedly a target of many attacks on their facilities, including those of civilians. Markets, one should not be surprised at the way they have behaved. In fact, surprisingly, negative impact has been far more contained. Like, for instance, when Ukraine-Russia war started in 2022, the oil hit 139. Stocks broadly lost more than 20% in most of the markets. But we are yet to reach that level of reaction. Potentially, we could see, of course, some more than what we have seen so far. The impact of the war is far more and involves many countries directly, both importing and exporting, oil as well as other products. I would be prepared for definitely still more bearish moves in the markets, unless there is some sort of a de-escalation very soon. Uh, as oil sustains higher level, the impact on inflation and resultant higher rates is already started to be discounted by the markets also. Central banks who were neutral have turned hawkish, and those who were nearing more cuts, like UK, there were two rate cuts being priced in, they have become neutral. So we are going to see monetary tightening as well as fiscal debasement together, punishing the bond market. And another big bear phase is likely there as well. So investors should be prepared for a long haul and period of uncertainty and low returns. And of course, one may ask why gold, which is considered the safest asset in times of war, should get sold more than 10%. But in the current situation, liquidity is in premium, and for gold in particular, it is reportedly facing selling pressure from Gulf nations hit hard by the war and resultant stoppage of export revenues. It's the reverse of what we had seen in late 2025 when sellers of precious metals just vanished when there was a hectic buying. Now, buyers, including central banks, have been conspicuous by their absence. And for a perspective, gold is still 70% higher than the level where it was at the beginning of 2025. So if the search for liquidity continues, we'll not be surprised to see further lower levels for gold and even silver, maybe gold towards 4,200 or 4,000, though I consider them to be extremely good levels for the long-term investors. As far as the dollar is concerned, it has held stable. There have been bouts of volatility on both sides. The short-term dollar strength or demand cannot be overlooked. However, the medium-term or the long-term dollar bearishness is definitely going to play itself once the dust settles. And of course, that is going to take some time as well. Now, currently, there is selective strength in the dollar, particularly against the EM currencies, and the major currencies are holding the range, and that is set to continue perhaps. As far as rupee is concerned, notwithstanding the large disproportionate move that we have seen in the INR in the last 1 year, trend intensity is very much continuing, and the central bank actions have just ensured that there is no runaway weakness in the rupee. The rupee's gross underperformance has been amplified even after the war. So since the war started, the rupee has lost more than 3% and nearly 3%. And while the dollar index has held within a range, but perhaps with some sort of a little bit gain for the dollar. So that is set to continue. For India, even before the war, I would say we had faced several challenges, on the export side, and the tech sector problems because of the AI disruption. All these things resulting in our trade deficit going higher, gold imports, and now the soil price. So if we are at 85 as a base for the oil, and it continues around those levels, the hit on our import bill could be additional 25 billion. If it is above 100, maybe up to 50-60 billion dollars. And in the context of missing capital flows, it's going to be a stress on our balance of payments, and that is keeping the rupee, rupee's current bear phase continuing, and perhaps will be so for quite some time to come. So we be prepared for more weakness. That does not rule out intermittent, strength, maybe driven by RBI or some sort of, some semblance of uh, ceasefire talks or anything like that. But I think even if the war stops completely, I'm not seeing a change in the direction of the rupee, broader change, broader turn. But yes, it could be at least the pace of weakness might reduce. But overall trend is very much intact. Thank you.
Thank you, JK. And just looking at things, the budget sentiment, it looks to continue this week. Uh, there is no real update on any sort of de-escalation. The world seems to be resigned towards this war continuing, and of course, it's been impacting the world quite significantly, especially in terms of the energy prices. Asian countries hit especially hard. Uh, if you look at the policy action, all central banks generally have now become inflation hawks. Those who were expecting more cuts, like the UK, have also become neutral. So generally, there is that concern. We are seeing inflation expectations by central banks going up 50, 70 basis points. So there is a lot of uncertainty over there. Inflation has come back into the driver's seat, and we are seeing a surge of liquidity. That's why gold is also being sold. Liquidity, as JK rightly mentioned, it's at a premium, and that's why we are seeing a lot of asset classes being sold. Dollar index has been relatively stable, but there is a selective strength in dollar against the EM currencies, rupee as well. It has continued its depreciative trend. Even before the war, there were challenges for us, and even after it, it has amplified because of the rise in oil prices. So till that time, all these factors sort of improve for us. We may see a overall depreciative trend for the rupee. But of course, there may be intermittent strength as and when RBI or some bigger flows hit the market. That's it from us today. Thanks for listening. We will catch up tomorrow with the fresh round of updates.